of billions of dollars. So that's the rough magnitude. I mean, basically, it was actually starting in the beginning of quarter 4 last year. You know, for the first 3 quarters of 2022, liquidity was falling because the Fed was, doing quantitative tightening. And, that kind of culminated in the treasury market was getting very liquid by the end of quarter 3. And then you also had the gilt market blew up.
Yeah.
Um,
And sorry to
and
interrupt, but that's when Janet Yellen began raising these flags of
yes,
cracks in the treasury market.
exactly. And you also had the dollar index kind of hit its peak, and that all kind of ended up around the late September period. And the Treasury General Account started drawing down more quickly at that point. And you actually, measures of domestic liquidity started trending sideways rather than down throughout quarter 4. And that kind of coincided with the dollar index coming off of its highs, the market coming off of its bottom. Treasury market liquidity still wasn't great, but it was no longer as bad as it was in that time. And so for kind of a multi-month period, we're in that sideways sort of trend. And that was in large part because the TGA was big enough to be offsetting some of the quantitative tightening. So that gives you an idea of magnitude. They drew it down from many, many hundreds of billions, and now it's below 300 billion. And so that was large enough to offset a significant percentage of quantitative tightening. Going forward, there's only, there's less than 300 billion left. It's still relevant on a scale. And when they get to a point where they want to refill it, I mean, their kind of baseline number for where they want it is around $500 billion. And so that's if they draw it down to roughly zero, down to the hour during the debt ceiling, and then they want to refill it, that's $500 billion that wants to get sucked out of the market into this like liquidity void. And so it's smaller than reverse repos. But it is a meaningful percentage of it, and especially when there's already liquidity issues in the system, it's certainly a meaningful variable.
Right, right. No, that's what I wanted to put the spotlight on here. And so interesting. So sort of starting around Q4, we had the monetary brakes being put on, but we had sort of this fiscal accelerator that was being pressed on. Now the accelerator will come off at some point. Listening to Powell and the Fed, they're still going to keep their foot on the brakes, right? They'll still be tightening or at the very least pausing here, right? And probably still continuing QT. So sort of what you're saying is, or what I hear you saying is, hey, there's going to kind of be this shoe that's going to drop here of receding liquidity. And then, of course, you add to that the incremental tightening of credit standards of lending that is going to go on now following the shakiness in the banking system here. And Jerome Powell talked about this, right? He said, hey, those substitute for additional rate hikes. So, he just hiked the Fed just hiked 25 basis points last week, but he said it's really more than that because we're going to have the impact of this additional tightening on here. So you have that. So that is constrictive to the economy. And then you have one of the things I've been talking a lot about in this channel, and I'd love to get your opinion on, is the lag effect, right? Of the 450 or so basis points hikes that have been made that we haven't really, as best we know, felt in force yet. They kind of travel through time. And so we have kind of the parade of shockwaves from those past rate hikes still traveling through time that'll be hitting the economy again and again and again over the next couple of quarters. So how concerned are you about this, kind of perfect storm almost, it sounds like, of additional liquidity contraction, tightening lending standards, continued tightening by the Fed, plus the lag effects, the avalanche of lag effects coming our way?
I think it's really concerning for quarter 3 or quarter 4. I think right now we're in a little bit of an eye of the storm where, like I said, liquidity indicators look okay looking out a couple months because you kind of have liquidity being taken out and other liquidity being put in. And the question is, when you get, towards the later part of this year, when a lot of these things all coincide to kind of be bad for liquidity and bad for growth, I think that's where storm clouds hit. And how concerned to be partially comes down to how you think people are going to navigate it, right? Because this is an actively managed system,
Mm-hmm.
and a lot of it will come down to human decisions. And I mean, there's ways to cause a massive liquidity shock, and there's also ways to just kind of like flood it with liquidity, and kind of weaken on the inflation fighting front. And so I think it'll be pretty pivotal decisions by the Fed. I think an instructive period to be familiar with is the repo rate spike of 2019. That was the last time that quantitative tightening ended. The Fed was drawing down their balance sheet in 2018, 2019, and they did so until September 2019 when they caused their repo rate between banks to blow out. And the Fed had to come in and participate in the repo market. But then, there are a number of us at the time that were pointing out that they were basically the system was being flooded with T-bills, and the Fed was going to have to start buying some T-bills. And about 3 weeks later, that's what they had to do. And I think we're kind of in a similar environment now, where right now they're still trying to be tight with their actual balance sheet, but then they're offsetting it by loans. And I think they're going to find a time later this year where they're unable to keep doing quantitative tightening. It doesn't mean that they necessarily turn to QE right away,
Mhm.
but I do think that at least on one of those liquidity fronts, that quantitative tightening portion, I think that's likely to stop because there's not much else liquidity that can come from the system. And I think that's the thing that I think they overall kind of basically overestimated how much liquidity is in the system.